Hello financial fans, welcome back to another stock analysis. Today we'll be covering Tesla Inc. stock ticker TSLA. Tesla is an American multinational corporation that designs, manufactures and sells electric vehicles, energy storage systems and solar panel products. The company was founded in 2003 by entrepreneur Elon Musk with the goal of producing electric cars at an affordable price to accelerate the world's transitions to sustainable energy. Tesla's main product is the electric car, with models such as the Model S, Model X, Model 3 and Model Y. They also produce energy storage systems and solar panel products for residential and commercial use. In addition to producing and selling these products, Tesla is also involved in the development of self-driving technology and operates a network of electric vehicle charging stations. Currently, they're sitting at a $386.5 billion market cap, and in 2021 they generated a revenue of $53.8 billion. Recently, they have dropped their car prices, making some of their cars applicable for the $7,500 EV tax credit. The semi-truck that they have designed has been launched last year, and the Cybertruck will be coming very soon. Their full self-driving service is currently in beta and being tested and developed behind the screen. 94% of the deliveries of Tesla are Model 3 and Model Y, which in the bottom left picture you can see is the second and the fourth car. 6% of the deliveries are Model S and Model X, which are the first and the third car in the bottom left picture. 85% of their revenue is generated from the automotive, 7% from services, 5% from energy, and 3% from leasing. To determine the final valuation of Tesla, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 20% that can either increase or decrease by the financial ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in a scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT is not visible because of the margins, but it has grown from minus $400 million in 2013 to $6.5 billion in 2021. The average growth in EBIT here was 32.2%, meaning a 10% deduction from a margin of safety. The margin has gone from minus 3% to 12% in 2021. The average margin growth was a whopping 25%, which means a 5% deduction from a margin of safety once again. The final two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, you have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the companies to pay off all of their debts. For Tesla, it's 0, since Tesla has no net debt, seeing as the cash they have on their balance sheet can cover all of the debts, meaning a 5% decrease from a margin of safety. The return on invested capital for Tesla is sitting at 29.4%, meaning another 5% deduction from a margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Tesla. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2018 to 2021. This, since then, is when they became cash flow positive. The average growth during these years was 109.8%. And since we're calculating the lifetime expected growth up until 2030 for Tesla in cash flows, I've gone with 25% of this average, which is 27.46%. With this percentage, we can determine the future free cash flow of Tesla and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%. Out of this, we get a sum of free cash flow of $762.8 billion. All we have to do to get our equity value is then add the debt, the cash and equivalents, and subtract the debt. Then we get our equity value, which is $771.6 billion. The last thing we have to do to get our discounted cash flow price per share is divided by the shares outstanding, which for Tesla is 3.16 billion shares. The discounted cash flow price per share then is determined at $244.20. And with the current price of $122.40, the upside here is $121.80, which is almost a 100% upside. The second model that we'll be using is Graham's revised valuation formula, coming from the legendary value investor Benjamin Graham. In this valuation, we take the EPS of Tesla and the growth rate estimate of Wall Street, which is 35%. We also have to look at the average yield of AAA corporate bonds and the current yield of AAA corporate bonds. Out of this model, we get a fair value of $134.01. And with the current price of $122.40, here the upside is $11.61, which is almost a 9.5% upside. The last valuation model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to Tesla. In this case, I've chosen for BYD, since they're the second largest BEV manufacturer, and General Motors, because they come in as the third largest BEV manufacturer. BEV, by the way, stands for Battery Electric Vehicle. Then we get an average PE of 32.36. And all that's left to do to get our fair value here is multiply by the earnings per share that Tesla is generating, which is $3.24, leaving our fair value at $104.85. And with the current price of once again $122.40, here the downside is $17.55, which is a 14.34% downside. Let's go look at our final overview of our valuation model next. Looking at our final overview, we've imported the discounted cash flow, Graham's valuation, and the multiple valuation price per share, leaving us at an average price per share of $161.02. The margin of safety we have determined earlier by using a standard margin of safety of 20%, deducting 5% for the debt to EBITDA ratio, deducting 10% for the EBIT growth, deducting 5% for the margin growth, and deducting 5% for the return on invested capital, leaving us with a negative margin of safety, meaning that we would like to pay a premium to own the stock. This leaves our fair value of $169.07, and with the current price of $122.40, this leaves our upside at 38.13%. This leaves our upside at 38.13%. Meaning, in this case, it's a buy. If there's any other companies that you would like to see on this channel, please let me know. And thanks for watching.